Most people think XRP adoption shows up in press releases, partnership announcements, or flashy headlines. They assume if something important were happening, it would be obvious, loud, and impossible to ignore. But that assumption is exactly why so many people miss the real moves when they're actually happening. Because sometimes the most meaningful signals don't come from hype at all. They show up quietly, buried inside documents most people never bother to read. There's a belief floating around that global powers are either ignoring crypto or actively hostile toward it, that the only places experimenting with digital assets are Silicon Valley startups or speculative traders chasing returns. That belief sounds comforting, but it's wrong. And today, I want to walk you through why one major country, far outside the usual crypto spotlight, has been quietly studying XRP for years while the rest of the market was busy arguing about price. Let's start somewhere most people aren't paying attention at all: emerging markets. Because while developed economies debate regulation endlessly, emerging markets tend to move differently. They build first, test systems in real conditions, and worry about formal frameworks later. And that difference matters when you're talking about financial infrastructure instead of speculation. Recently, a major crypto exchange in South Africa secured an over-the-counter derivatives provider license. On the surface, that sounds boring. But once you understand what that license actually unlocks, futures, options, swaps, derivatives tied directly to crypto, you start to see what's really happening. Crypto liquidity is being pulled into traditional financial plumbing, not as an experiment, but as an extension of existing market infrastructure. That matters because it signals institutional depth, not excitement, not hype, depth, more liquidity, more settlement demand, more reasons for serious capital to care about how assets move, clear, and settle across borders. And this is exactly where XRP starts to show up in places most people aren't watching. Now, this is where things get uncomfortable, because while Western media spent years declaring crypto dead or dismissing XRP entirely, other parts of the world were doing something very different. They were researching, stress testing, modeling, evaluating blockchain rails for cross-border settlement, and XRP wasn't mentioned casually. It appeared for a reason. There are translated documents from a major central bank that explicitly reference Ripple and XRP in the context of cross-border payments. Not endorsements, not announcements, research, testing, evaluation. And that distinction matters more than people realize. Central banks don't experiment for fun. They experiment because they're preparing for real-world use cases that existing systems can't handle efficiently anymore. This isn't about East versus West. It's not about politics or ideology. It's about systems under pressure. When countries are pushed out of legacy settlement networks, they don't complain forever. They look for alternatives, neutral rails, efficient settlement, assets that don't belong to any single nation. And when you see XRP appear repeatedly in that context, it tells you something important about how it's being viewed behind the scenes. So the real question isn't whether XRP is being talked about loudly. It's whether it's being taken seriously where it actually matters. And once you start following the documentation instead of the noise, a very different picture begins to emerge. In the moving forward, we're going to go deeper into why emerging markets move first, why derivatives and settlement infrastructure matter far more than headlines, and why XRP keeps showing up in places that have nothing to do with retail speculation, even when the market insists nothing is happening. To understand why these signals matter, you have to understand how institutional systems actually evolve, because they don't move the way retail markets do. Retail looks for confirmation through price. Institutions look for confirmation through structure. They don't ask whether an asset is popular. They ask whether it can survive stress, move value at scale, and function under pressure without creating political or operational risk. This is why emerging markets are so important in this story. They don't have the luxury of endless debate. They face real constraints first: currency volatility, capital controls, cross-border friction, settlement delays. When the legacy system becomes inefficient or hostile, they don't wait for permission. They experiment, they test, they build. And only after something works do they worry about formalizing it. That's exactly what's happening when you see crypto exchanges in regions like South Africa securing derivatives licenses tied to crypto assets. On the surface, derivatives sound like trading tools. In reality, they're liquidity tools. They allow hedging, risk management, price discovery, and institutional participation. You don't build derivatives markets unless you expect serious capital to show up. And you don't wire those derivatives into traditional finance unless you intend to integrate crypto into the existing system, not replace it. This is where most people misread the signal. They assume adoption means people buying tokens. That's retail thinking. Institutional adoption starts with infrastructure, custody, derivatives, settlement, collateral. It's boring, it's technical, and it doesn't move price immediately. But it's how markets mature. By the time retail notices, the framework is already in place. Now take that framework and look at the central bank documents being circulated. When a central bank references a specific blockchain or asset in research related to cross-border settlement, that's not accidental. These institutions are conservative by design. They don't name things they haven't evaluated. They don't publish research on assets they haven't stress tested. And they certainly don't waste time on systems that can't meet their requirements for neutrality, speed, and reliability. XRP shows up in these contexts for one reason. It solves a problem that traditional systems struggle with. Cross-border settlement is slow, expensive, and politically fragile. When a country is removed from dominant messaging systems or settlement networks, the weakness of the existing architecture becomes obvious very quickly. At that point, ideology doesn't matter. Efficiency does. This is why the language used in these documents matters so much. Terms like bridge, settlement, and interoperability are not speculative language. They describe function, not investment. They describe how value moves between systems that don't trust each other. That's a very different role than what most crypto assets are designed to play. And this is where the market disconnect becomes clear. While retail debates whether XRP should be higher or lower on a chart, institutions and governments are evaluating whether it fits into a future settlement framework. Those two conversations are happening on completely different timelines. One is emotional and reactive. The other is slow, deliberate, and structural. None of this means outcomes are guaranteed. Research does not equal deployment. Testing does not equal adoption. But pretending that these evaluations are meaningless because price hasn't reacted yet is a misunderstanding of how change actually happens at scale. Systems don't flip overnight. They transition quietly, then suddenly. In the move forward, we're going to zoom out even further and connect these regional moves to the broader geopolitical shift taking place right now, from dollar dependency to alternative settlement routes, and why crypto, and XRP specifically, fits into that transition far more naturally than most people realize. Once you zoom out far enough, this stops being about individual countries or isolated experiments and starts looking like a much bigger realignment. What's happening right now is not random. It's not coincidence. It's a slow, uneven shift away from single-rail financial dependence toward a world where multiple settlement paths exist at the same time. And that shift is being driven by necessity, not ideology. For decades, the global system revolved around a small number of choke points: messaging systems, correspondent banks, clearinghouses, reserve currencies. As long as everyone played by the same rules, that system worked well enough. But the moment access becomes conditional, the weaknesses are exposed. When countries are cut off, delayed, or constrained, they don't ask philosophical questions. They look for alternatives that reduce vulnerability. This is where the conversation around BRICS, alternative payment systems, and commodity-backed settlement starts to intersect with crypto in a very uncomfortable way for people who still think this space is about memes and speculation. The discussions happening at this level are not about launching flashy new currencies or replacing everything overnight. They're about settlement efficiency, netting balances, collateral mobility, and neutral units of account. In other words, plumbing. Gold comes up in these discussions for a reason. It's universally recognized, politically neutral, and easy to value. But gold alone doesn't solve modern settlement problems. It's slow to move, expensive to transport, and inefficient for real-time reconciliation. That's why digital systems are being layered on top of these frameworks. Not to replace hard assets, but to move value more efficiently between parties who don't fully trust each other. This is the gap crypto was always meant to fill, not as a rebellion against the system, but as an upgrade to it, a way to move value continuously, transparently, and without relying on a single intermediary. And when you look at which assets are being referenced in the context of cross-border settlement and interoperability, you start to see why XRP keeps showing up in these conversations. XRP isn't positioned as a store of value like gold. It's positioned as a bridge, a neutral asset that can sit between systems, currencies, and jurisdictions without belonging to any one of them. That's not a retail narrative. That's an infrastructure role. And infrastructure roles don't need public excitement to matter. They need quiet acceptance from the entities that actually move money. At the same time, the West is not standing still. While the language sounds different, the direction is remarkably similar. Tokenized collateral, on-chain settlement for traditional assets, and the modernization of repo and clearing systems are all pointing to the same destination. Legacy finance is moving onto digital rails without calling it crypto because the function matters more than the label. This is where a lot of people get confused. They think this is an East versus West story. It isn't. It's a convergent story, different regions, different motivations, same pressure points. Everyone is trying to make settlement faster, safer, and more resilient. And everyone is experimenting with different tools to get there. And when you step back and connect these dots, it becomes harder to argue that what's happening is accidental. South Africa building derivatives infrastructure, central banks documenting and evaluating XRP, commodity-backed settlement discussions, Western institutions tokenizing collateral, funds accumulating exposure quietly. These aren't disconnected events. They're parallel responses to the same structural problem. And this is why price alone is such a poor guide in moments like this. Markets are excellent at reacting to emotion. They are terrible at pricing structural change early. By the time the narrative becomes obvious, the groundwork is already finished. The repricing happens after the positioning phase, not during it. Once you see this as convergence instead of chaos, the real challenge shifts from analysis to behavior, because understanding what's happening doesn't automatically mean you'll benefit from it. Most people don't lose in markets because they picked the wrong thesis. They lose because they couldn't stay aligned with that thesis when it stopped being emotionally rewarding. This is where XRP becomes psychologically difficult to hold. It doesn't constantly validate you. It doesn't move in clean, satisfying trends while the infrastructure is being built. It sits in long periods of compression, interrupted by sharp moves that very few people are positioned for when they happen. That behavior frustrates traders, exhausts long-term holders, and creates the illusion that nothing is happening when structurally quite a lot is happening. Retail investors tend to confuse activity with progress. If price is moving, they feel productive. If it isn't, they feel stuck. But institutions don't operate on that feedback loop. They care about whether access is expanding, whether settlement options are improving, and whether risk is being reduced. That's why they're comfortable positioning quietly while sentiment is muted. Low excitement lowers volatility, and lower volatility reduces risk when building exposure. Another mistake people make is assuming that infrastructure adoption should look obvious in real time. It never does. When systems are being integrated, tested, and standardized, the work is incremental and largely invisible. By the time it becomes visible, the easy decisions have already been made. At that point, the risk-reward profile has changed, and late participants are forced to chase confirmation instead of positioning early. This is also where impatience becomes expensive. People tell themselves they're early, but then act as if the market owes them immediate feedback. When that feedback doesn't arrive, they start questioning everything. They compare XRP to assets optimized for speculation rather than settlement and conclude they made a mistake. That comparison is flawed. Different assets serve different purposes, and they're rewarded on different timelines. Institutions don't ask whether something is exciting, they ask whether it will still be relevant years from now. That's why they focus on interoperability, neutrality, and liquidity rather than narrative dominance. And that's why their positioning often looks boring right up until it suddenly doesn't. None of this means outcomes are guaranteed. Structural convergence doesn't eliminate risk. Regulatory shifts, competing standards, or slower than expected adoption could still change the picture. The point is that these risks are structural, not emotional. They require monitoring process, not reacting to noise. So what this means for you right now is clarity. You need to know whether you're positioned for infrastructure convergence or trading momentum. Mixing those two approaches is where most damage happens. If you're here for the long term, you have to accept long periods of discomfort. If you're trading, you have to respect the asset's behavior instead of forcing narratives onto it. When you pull all of this together, the story stops being about one country, one document, or one moment in time. It becomes about how financial systems evolve under pressure. They don't change because people get excited. They change because the old structures no longer work efficiently in a fragmented world. And when that happens, the assets and networks that survive are the ones that can operate quietly, neutrally, and at scale across borders that don't trust each other. XRP sits in that uncomfortable middle ground where it's too institutional for pure crypto speculation and too crypto native for traditional finance to talk about openly. That makes it easy to dismiss in the short term and difficult to categorize in the present. But history shows that this is exactly where infrastructure assets live before they become unavoidable. They're ignored, misunderstood, or mocked until enough systems quietly depend on them that removing them becomes impractical. What we're watching right now isn't chaos, it's convergence. Different regions, different political motivations, different economic pressures, all moving toward the same conclusion. Settlement needs to be faster, more resilient, and less dependent on single points of failure. Some regions talk about gold-backed frameworks. Others talk about tokenized collateral. Others build derivatives infrastructure. Different language, same destination. And when you see XRP repeatedly referenced in these contexts, not as hype, but as a bridge, it tells you how it's being evaluated behind closed doors. The mistake most people make is assuming that opportunity announces itself loudly. It doesn't. Opportunity shows up as discomfort, as boredom, as long periods where nothing seems to happen while everyone's attention is somewhere else. By the time consensus forms and narratives shift, the positioning phase is already over. At that point, the asset may still move, but the asymmetry that created outsized opportunity is gone. This doesn't mean you suspend critical thinking. If the facts change, you reassess. If the thesis breaks, you adapt. Discipline is not blind belief. Discipline is staying aligned with evidence instead of emotion. You should be able to explain why XRP would matter in a future settlement landscape, what risk could derail that outcome, and what would make you change your mind. If you can't do that, then volatility will always feel threatening. So the real takeaway here isn't a promise, a timeline, or a price. It's a framework. Understand the difference between speculation and infrastructure. Understand why governments and institutions move slowly and quietly, and understand that markets are very good at pricing excitement, but very bad at pricing structural change early. And before we close, this is important to be clear about. This content is not financial advice. It is not a recommendation to buy, sell, or hold XRP or any other asset. Markets, especially crypto markets, are volatile and unpredictable. You are responsible for your own decisions. Always do your own research, assess your risk tolerance carefully, and never rely on someone else's conviction instead of building your own.